this morning for the results, the fact that you aren't seeing any impact from inflationary pressures on customer demand, and you're continuing to show signs of growth across key metrics right now.
That's right. We have not seen any impact. Our quarter-over-quarter numbers look great. Our year-over-year numbers look great. Our cohorts are incredibly healthy. And on top of that, we found a number of cost efficiencies we identified and have several other efforts underway, which is what really allowed us to both beat top and bottom line this past quarter, as well as raise top and bottom line guidance for the rest of the year.
And that guidance doesn't factor in a launch in Canada. It doesn't factor in the Golden Nugget purchase that just closed last night as well. How would you expect those to contribute to the financials over the coming months?
Well, as we noted on the earnings call, even with obviously a new launch in Ontario is going to carry some upfront investment, but even with that investment, we'll still be better than where we guided to last quarter for total year EBITDA. And obviously, we'll have significant acceleration on the top line both this year and in future years from both of those things. So I think Golden Nugget's going to add a ton of synergy, which will eventually make its way to the bottom line. Ontario will obviously contribute meaningful contribution profit, and both will grow top line in this year and beyond.
Now, we know in the states where sports betting, mobile sports betting is already alive and well, it's been very competitive. It's been very promotional. We have a number of states here in the U.S. Set to roll out this type of option as well. Walk me through the competitive landscape and what that's going to mean in terms of marketing and in terms of investment for DraftKings.
Well, it's really rationalized quite a bit over the last quarter or so. We've seen a dramatically different competitive environment, and that a lot of what we deem to be uneconomical customer offerings or media purchasing is not happening as much or really at all anymore. We've sort of stuck to the same playbook, 2 to 3 year paybacks on new customer investments, 2 to 3 year paths to profitability in states. What we're seeing, though, is we might actually now, through some efficiency opportunities identified, as well as a rationalizing competitive environment, we may actually have an opportunity to pull both of those things in to get both faster paybacks on our customer acquisition investments, as well as faster path to profitability in new states that we launched, largely due to a much quicker developing and higher use of the, higher adoption from the population of new states we've launched recently, like New York and Arizona.
Hey, speaking of new states, Jason, I wonder, do you think that the macro, the slowing environment we're in is going to push states who've held out toward maybe taking another look at legalization? Or is that, at the state level, is that just too hard a needle to move right now?
Well, I think it certainly adds to, the attractiveness when states are in search of new revenues and, they don't want to raise taxes on their citizens, and they have, companies that are voluntarily willing to pay taxes to help raise those revenues. That, I think, is a very attractive value proposition in any economic environment, but certainly more so in one where states are not flush with cash the way they have been for the last year or two. So I think there's a number of factors that affect what happens in every state. Each state has its own unique politics, but on an overall macro level, I think you're right that will help gain more momentum.
Last time you were on with us back in February, you were asked the question about the fact that the stock had been plunging. You said that it's a wild market right now. It's more of a reflection of an unstable stock market, not the company's performance. Given the fact that the stock is still down 70% over the last 12 months, and despite strong results this morning, under a little bit of pressure right now, currently trading down 3%, I wonder what you think it's going to take for investors to buy into this strategy that you're laying out.
Well, I think that for us, it's less about what it's going to take for them to buy in and more developing a consistent track record of executing and delivering on the things that we've said we're going to do. I think that in any environment is what's attractive to investors. Certainly, market cycles make certain types of companies, certain types of sectors go in and out of favor. But over the long run, the companies that get the best multiples and do the best are the ones that deliver on the things that they say they're going to deliver on. So that's really what we're focused on. At our investor day last March, we promised $2.1 billion in EBITDA at maturity. We continue to march towards that goal. We've repeatedly said we're well capitalized and that inflationary pressures are having no impact on our customer. As long as we follow through on those things, I think smart investors will continue to catch on. And really, we can only control what we do, which is to deliver really strong execution, generate great results, and run a great company, and, of course, deliver on the promises that we make.
Jason Robins of DraftKings, thanks for joining us this morning.
Thank you.